Well, our next guest says, given all of these factors, investors need to move away from the traditional investing playbook because of recent volatility and also because of low yields, which we were also just talking about. Joining us now is Sean O'Hara. He's Pacer ETF's president. Sean, thank you for joining us. So obviously, we're in this sort of delicate environment right now where on the equity side, you have a lot of volatility because of the trade war. On the bond side, you have very low returns and in some cases negative returns because of what's going on with central banks around the globe. So where should investors be looking?
Well, thanks for having me this morning. It is a difficult challenge. You know, the traditional asset management model over the years has been this modern portfolio theory approach, asset allocation, with a big component for people who are concerned about downside risk, owning a substantial portion of their portfolio in fixed income investments, which would have acted as a buffer to the downside. With interest rates at the current level and in some places either zero or negative, that approach is a real challenge to investors because I don't think you're going to get that buffer on the downside that you used to be able to count on if the equity markets turn down. So I think going forward, I think what investors need to do is to try to find alternative places where they can generate some yield. And I think we're going to continue to see what we sort of saw for the entirety of the previous administration, which is pushing people towards risk-based assets to satisfy their long-term investing needs.
And do you think that's the right approach? I mean, when you're looking at alternative places to get yield, are there places available that are not overly risky?
Well, I mean, with bonds where they are, bonds are very risky as well. I mean, if interest rates were to move up substantially, you could lose a substantial amount of your money in bonds or see your value drop substantially. So I think that's the trade-off. I think there are places to get yield. You know, one of the areas that we get yield today for our ETF investors is in publicly traded real estate. We took that market and dissected it and focused, for example, just on the data centers and the cell phone tower companies. And you can get a competitive yield there. They're not necessarily 100% correlated with the equity markets. They've had a nice return year to date. And that may be a way for an investor to take a portion of their portfolio and put it in a place where they can actually generate some income and not be susceptible to a one-for-one decline if the stock market were to decline.
You know, previously I was looking at the markets and they were all in the green, but now it looks like they dipped back into the red. What do you think investors should be expecting in terms of the evolution in the trade war now that they're fighting over who called who had a missed call, that kind of thing?
Yeah. It's been a real challenging year as far as that's concerned, and I think it's going to continue as this trade war continues. One day good comment, markets up. One day bad comment, markets down. You know, I think from an investor's perspective, I think the market is looking forward at what they think the earnings are going to be next year and then trying to put the right multiple on it. That's the way, in my opinion, the stock market works. The challenge with this trade war is that if everybody expects the market to earn, let's say the S&P 500, $185 in earnings next year, how much of those earnings will evaporate if this trade war continues, and then what should the multiple be? And so I think in the short run, I just think if you're going to be an equity investor, you just sort of have to accept the fact that you're going to have this day-to-day back and forth, sort of like a ping pong match, if you will, until we get some form of a resolution on the trade issues with China. You know, what's lost in all of this is that the trade negotiations with everybody else have been going fairly well. China is the big one. And it's probably the most difficult because it's not necessarily 100% tied to trade. It's also tied to the intellectual property issue and the theft of that intellectual property that's been going on. And that's one of the big drivers that they're trying to stop.
One of the other areas you like, by the way, besides REITs, are chips, which is interesting because they certainly have been volatile. They're volatile even in the best of times. And they've been quite volatile recently because of the trade war. So what has drawn you to that sector?
Well, two things have drawn us there. One, in our Cash Cows series of ETFs, we screen for free cash flow yield, and the chip makers generate huge amounts of free cash flow and a high free cash flow yield. So essentially, you're getting an inordinate amount of cash flow relative to the overall market for the price you're paying for those names today. They are volatile in the short run because of the China issue. But in the long run, as you start to think about the evolution of some of these other technologies, whether it's streaming or 5G or the Internet of Things, or as e-commerce continues to get built out, autonomous vehicles, artificial intelligence, all of those things are going to take a massive increase in the data capacity we have here in computing power. And that computing power can't happen without the chip makers. And so there's a sort of a long-term macro trend that goes with these names in terms of where they are in the business cycle. There's going to be a huge amount of money spent building out data capacity in the United States. And one way to play that is in the real estate space, as I mentioned earlier, and the other way to play that is with the chip makers.
All right, Sean, good to see you. Thank you, Sean O'Hara.